I think Hugh Young is back with us. Hugh, is my voice reaching you? Good morning.
Good morning to you.
Oh, finally, Hugh. Okay, we've been waiting to get this audio connection for a while. Hugh, have to get in your reaction as to what the budget was. What were the key takeaways from an FII like you?
Well, I think as far as the broad economic measures taken, generally positive. So investment in infrastructure, roads, rails, investment in the agricultural sector, for example, all good news. Helping out those less well-off with health insurance and the like. Again, good news. And probably the only bit of negative news for us and of immediate negative news was the announcement of the long-term capital gains tax imposition. And of course that causes complications for the likes of us and by definition makes investing in India less attractive, mathematically less attractive, and more immediately we're just trying to work out exactly the effects it has on the substantial investments we already have within India, exactly when does it start to take effect, etc., etc. The nitty-gritty details that of course are not announced in full at the time of the budget.
Whereas your current investments are protected, the future returns could be down by 10% on the profits you make. Is that a very substantial change? Because the promise for future returns in India is still very strong. Foreign investors may just have to take a hit of 10%. So it's like saying that someone has taken a small piece from your cake. That should be perfectly acceptable.
It could well be acceptable. It's just a matter of calculating. Mathematically, it makes in India marginally less attractive by definition. So if you do lose 10% of future gains from today, and it's a marginal call with somewhere else, yes, it would cause people to step away from India a bit. I mean, I don't think it will have any great effect on what we do in India and our long-term position in India, and many of the shares that we hold within India we've held for 10, 15, even 20 years. So we're very long-term investors in India. We don't churn our portfolios, but it will be, at the margin, it will make it less attractive.
The way stock markets or the way asset prices move is that they look at two things: cost of capital and future returns. So currently cost of capital in India could go higher because yields have gone higher, and future returns after the tax will be down by 10%. Could that have an impact on P multiples and Indian stock prices?
Yes, I think mathematically it could, certainly from the FII point of view, from anyone's point of view, mathematically that would have an effect. Of course, longer term, what we see in the other measures in the budget is generally an encouraging position for the overall economic growth of India. So if we're talking of figures comfortably starting with a 7% plus GDP growth, and certainly India's capable, if everything goes smoothly, of recording 7, even 8% GDP growth over the next five or more years. I think if things go smoothly, that gives a lot of upside as well. So you have to offset the one against the other. But all things being equal, higher capital gains tax and potentially higher interest rates make investing in the equity market less attractive from a purely mathematical point of view. But for us, we have to offset that with these broader measures that make India more attractive. So net, one suspects there won't be much fundamental change in how we regard India. We still want more reforms to come through, of course, as I'm sure everyone does in India too. Wants these programs, infrastructure programs, health programs, education programs. You want all those to be sort of pushed forward, but these things take time in a large country. It's not easy, but it's going in the right direction. So broadly, we continue to be very positive about India.
But Hugh, would you not say that perhaps in the near term the reaction is well priced in with the market, because this 10% long-term capital gains tax seems to be already in the price if you were to look at the year-to-date performance of India, or rather underperformance I should say, as opposed to other emerging markets?
But part of that is due to the fact that India's been far from a cheap market for quite a while. India's been one of the more expensive markets in which we invest. Part of that reason is due to anticipation of future growth. That future growth has been short-term, was slightly postponed by various measures with the demonetization. For example, the introduction of goods and services tax. Short term, that postponed a bit of economic growth and postponed a bit of corporate earnings growth, but ultimately longer term set things a lot fairer for the long-term growth prospects for the economy as a whole, and of course for corporate earnings. And in some senses, we've been waiting for corporate earnings to catch up with valuations, because valuations in India have been towards the pricey end when you compare India with other emerging markets. But of course, as I mentioned earlier, if anything, we see the long-term growth prospects of India coming out of all this in a far more optimistic light. So there is no reason why India should not be achieving 7% plus GDP growth for the next quite a few years.
Absolute comparison. Second is relative comparison. On a relative comparison with other emerging markets, how do you think is the India positioning, both in terms of returns and levels?
I mean, in India, I would say, is probably quite favourable. It's very hard. Emerging markets are all very, very different. They have different characteristics. And we rather glibly lump them all together as though Brazil, Russia, Indonesia, India, Nigeria are all the same, being emerging markets. Of course, they're not. They have different skills, different opportunities, and certainly as far as we're concerned within our emerging market exposure, India remains one of the largest elements of that. So great opportunity in India. There's obviously also great opportunity in countries like China, and on a selected basis in many of the smaller countries. But of course the opportunity set in smaller countries, smaller markets is less. And India has certainly been able to establish some global winners within the Indian market, which not that many other emerging markets have established global winners, or potentially global winners. Yes, of course, China has. Korea, which for some strange reason is still defined as an emerging market, has, with the likes of Samsung. But India's right up there and has higher potential than any of those countries I've just mentioned. So I think India's long-term growth rate should be superior to China's, certainly superior to the more developed emerging markets like Korea.
Right. Hugh, out of the statement that you made that you believe the LTCG can make India less attractive as an investment destination, just two questions rolled into one. I mean, given Aberdeen's current allocation to India, would that allocation be reviewed in the light of the fact that, across, so a lot of developed markets have long-term capital gains tax, but in emerging markets, it's a mixed picture. I'm given to understand that China and Thailand, as well as Singapore, have full exemption and they're partial exemptions with progressive taxation in Brazil and Indonesia. Would, on the basis of valuations or the LTCG issue, Aberdeen's India allocation be reviewed to perhaps some other EMs?
Well, we review our allocations regularly, and of course an event like this, which mathematically clearly affects returns, one has to input that into the computation, of course. Will 10% be sufficient for us to suddenly say, no, we're pulling out of India? I doubt it very much. But all things being equal, it does detract from India's long-term returns simply by definition. If you knock 10% off your long-term gains, that's 10% less than you would get anywhere else. But does India still offer the potential for substantial long-term gains, which makes the 10% tax livable with? Probably is the answer. So I doubt whether any great change will be made. But we also need to see the detail. It's quite complicated if we have dedicated open-ended and closed-ended India funds. So quite how do you calculate what's going on? So I think for the moment it's just being totally clear what the real implications short-term are for calculations of liabilities and so on, and then longer-term looking to see whether it does affect our view of India. And I think broadly it won't affect our view of India, but at the margin, of course, it has to.
Right. And, as part of the initial communication that's been done, you're talking about gains being made post Jan 31st. Now, my question to you is, given where valuations are, given the rally that we've seen in world equities, as well as the Indian markets through 2017 and 2018, do you believe that, over the course of the next 12 months, one can see that much more upside in the Indian markets? Because the government's thought process has been about how, they have looked at the gains that foreign investors have made in the Indian markets through the course of the last 10 years, 5 years, 3 years. Is that a fair, premise on which one can estimate whether gains will come through over the course of the next 12 months or 24 months, given where, global macros and global markets stand at this point? Are you as optimistic about the market's returns over the course of the next 1 year than what we've seen in the past?
Well, I think it's very dangerous, of course, to use the past to predict what will happen in the future, and maybe one of the figures that's open to challenge is the amount the government is hoping to raise from the imposition of the long-term capital gains. For any money to be raised, of course, that assumes the market does go up. So I presume the government broadly has assumed that the Indian stock market will continue to make returns for investors. I'm afraid markets are never necessarily quite so accommodating, and broadly looking at the world as a whole, markets and asset prices have been hugely inflated by the printing of money, the QE that we've seen globally. We're seeing that starting slowly to reverse and interest rates to go up. So from a flow of funds basis, one might not see such huge demand for risk assets such as equities. So of course you can see equity markets falling, even though the economy is still doing well, even though corporate earnings are doing well, because the current valuations are fairly high. So it'll be interesting to see whether the government's predictions for revenue raising do turn out to be at the levels they're anticipating. I know I'm sort of refusing to tell you whether I think the market's going up or down from here. Our skill is, as investors is not predicting short term, and by short term I mean 1, 2, even 3-year market moves. Our skill as investors is identifying great companies where we think the earnings will grow, and ultimately the share price will follow those earnings and will follow the dividends that result from those earnings, but it doesn't follow it in a smooth pattern. So in any given year you can see markets all over the place, both up hugely and of course unfortunately occasionally down hugely.
Hugh, so let's talk exactly about that. You know, some of the individual themes and sectors that you've been invested in for a while when it comes to India. And, you know, I know for a fact that you've been invested in Infosys and TCS and have been a very strong believer of the Indian IT companies for a while. When you go back to the drawing board and try and calculate the impact of LTCG, do stories like IT still weigh heavy on the scale? Because, you know, the fact of the matter is also that the Nifty IT index has only begun moving just now. From December to now, we've only seen a 20% move on the Nifty IT index. So there are those early signs of the sector bottoming out. Is that a space that you would continue to stick by? Because the deal pipelines, the deal follow-throughs are only just about beginning to come by, and seems like the dark clouds are just about lifting.
Well, it's a sector at which India excels. It is today far, again by definition, far more mature than it was 10 years ago. So the days of dramatic growth within the IT services sector, I think, are largely over. But that is admittedly reflected in the valuations in the IT sector. They have come down substantially and are quite reasonable. The companies, TCS, Infosys, have strong cash flows, strong cash balances, and are changing their businesses. The businesses have become more complex, if you like, and the interactions with customers have become a lot more bespoke, and they're generally doing a good job at that. And it's a constant battle in any business to keep at the forefront, and I think India's doing a pretty good job there, and I can't see us having a major change on the sector either. The companies are doing well. They all have their issues, of course, but clearly India is a market leader in that field and is likely to remain so.
You've never bought public sector enterprise or PSU stocks in India. I mean, with the rarity of 1 or 2 in the past. But is your view changing there, given that PSU banks would be recapitalized, companies are getting more efficient now, and both in terms of the management and also in terms of the way they're conducting their business?
Yes, you're right. Generally, we've been quite wary of the government sector, and I'm afraid typically that's not just restricted to India. I mean, it leads to scepticism wherever we invest globally, because often a government has a slightly different agenda when it comes to the businesses that it runs. So some, understandably, are very public service companies with not much regard for outside shareholders and various inefficiencies, and certainly we've seen that in many of the Indian state-dominated companies that have not been run as efficiently, particularly in the banks, if you compare them with the private sector banks, which have done much better, whether it be the HDFCs or the Kotaks or whatever. But is that reflected in price? Yes, it is. The state banks certainly, if you're just looking at ratios, look good value. The debt restructuring is a great help and really, I mean, it's ultimately it's extremely important for India as an economy to sort out the banking system and give it more flexibility. I would say there need to be more mergers within the banking sector, more consolidation, and the important question we're asking is whether the management and disciplines within these institutions really has changed. It's a bit early to come out with a definitive answer. If the answer is yes, management has changed and cultures have changed within the state banks, then there's certainly from a shareholder point of view, there's a lot more to go for within them.
In the past, you've owned private banks, and that investment really has given your unit holders and your shareholders a great return. Now the Indian insurance sector has also opened up, and you have the same dynamics. This was a sector which was dominated by government, and now private sector is gaining market share on a daily basis. So after private banks, can I close my eyes and, knowing your style, safely assume that insurance could be Aberdeen's next bet?
Yes, you're correct. I mean, it's clearly an area of great interest to us, and we've done a lot of work on it, and there's some good companies in that area. So yes, as a long-term investor, that's exactly an area we're looking at. Of course, a bit like the banks, the prices are not particularly cheap today, but I don't think you would expect them to be that cheap.
Right. Hugh, you know, Dr. Mark Mobius called India the small cap treasure house. I have, of course, gone through some of Aberdeen's portfolios. Do you think that in this budget, with that corporate tax cut coming in for some of the companies having revenues of up to 250 crores, that could open a window of opportunity for you to hunt through the mid caps and the small caps here, purely on account of what the corporate tax reduction would do for their profits and for their expansion plans?
Again, where there is a cut in corporate tax, that will be a benefit, and we're looking right through the Indian market, large and small cap. So we have funds that invest in dedicated small caps, where we've had exposure to Indian small caps for a very long time, and within our India funds we have a range of the obvious large caps. As well as small caps. And I suspect in itself any change in tax will be very much at the margin. So it's unlikely to tip us from saying a company's gone from one we wouldn't look at to one we would look at. I mean, it's obviously would be a benefit, but it will be a marginal benefit.
Hugh, you know, you were earlier reiterating to the fact that India is also expensive, aside of LTCG and what the budget takeaways have been. The fact of the matter is that this market has given you an excellent return all of 2017, and therefore also you're going to go back to the drawing board and figure out, what do I do with my investments? In the past, you've also owned extremely expensive names, the likes of a Unilever, the likes of a Nestle. Is that a given then, that you would perhaps be trimming your exposure in these names? Or maybe not, because the story continues to look good to you?
I mean, it's I mean, it's certainly not a given, and we do own Unilever and Nestle and a few other expensive stocks, hopefully with decent long-term prospects. But of course they need that long-term growth to justify the prices at which they're standing today. But if you take a broader step back and look within emerging markets as a whole, you'll find a similar pattern right across emerging markets, right across global markets. There is very little that you would say is really, in absolute terms, cheap. Because, of course, all markets worldwide have been buoyed by this tremendous amount of liquidity. So certainly given the age I am, I tend to worry more and more about the downside. And after years of good markets and good returns, inevitably one has to worry about things going wrong. Importantly, we don't see any signs of things going wrong within India itself. So with the fundamentals going wrong, we don't see that happening. If anything, we see the long-term fundamentals improving with all the reforms being put in place, and the emphasis on infrastructure, etc., is very positive. But of course, we have seen financial markets don't necessarily take much to drop 10, 20% even. So again, I've been looking after money back in the 80s. So I've been through the 87 crash, the Asian crisis with the same funds that we run today. So it can be a very bumpy ride, and there's certainly potential for markets to pull back, but certainly relatively, in India looks a safer bet than many other markets.
You don't worry about age. There is enough anecdotal data which says that Buffett has made 99% of his wealth after he turned 60. So I can assure you, you still have a long, long way to go. And markets is the only space where experience matters. The more time you spend, the better you get.
Yes, although youth helps when you have no fear in markets like this. It's a positive, but I'm still full of fear by nature.
Don't worry, Hugh. You'll always remain a rock star, whatever age, and we'll chat again soon once you've done the budget math and tried and figured out what you want to do with your holdings and portfolio when it comes to India. Okay, that's as big as it gets. Hugh Young, Managing Director, Aberdeen Asset Management Asia, telling us all that he made of the budget 2018.